The Fed has been pumping liquidity in like you wouldn't believe there's any tomorrow, right? And they've been doing it for a long, long time. This isn't just the virus related, is it? There's a structural question as to whether the Fed is actually just blowing the bubble higher.
Yeah, well, providing liquidity is a nice way of saying it. What they're doing is they're creating inflation. They're just inflating. They're monetizing government debt, and they're buying assets with the money that they create out of thin air. And the goal is to prop up those asset prices, but also to enable massive U.S. government spending. In fact, the U.S. government is spending more money that the Fed prints than it collects in taxes. And so we're trying to keep this whole pyramid from collapsing. But eventually, it's going to happen. And the fact that they delay the day of reckoning with this policy just means that when that day arrives, we have a lot more to reckon with. And so it's a much bigger crisis than would have been the case, had we faced the music years ago.
And of course, it's not just the Fed, but central banks around the world are following suit. Here in Australia, the RBA took their rates to 0.1% last week and announced a quantitative easing program. We've got the same going on, of course, in Japan and in the Eurozone and in the UK. So everybody's just going down the same path.
Right, but I think they're following the Fed's lead because everybody is afraid of having normal interest rates because nobody wants their currency to appreciate, which seems counterintuitive because a strong currency is a good thing. It means that your wages have more value, your savings have more value. You can buy more stuff for less money. You have a rising standard of living. But modern day central bankers, for some reason, have no common sense, and they think that weakness is strength. But eventually, when consumer prices really start to rise, the public around the world is going to be, protesting the rise in the cost of living. And so interest rates are going to eventually rise, and they're probably going to rise much higher than they ever would have gone had the central banks not gotten so far behind the curve. But the countries that have the most amount of debts are going to be the ones that are least likely or able to raise rates. And so inflation is going to just ravage those economies.
And if I think about that liquidity that's been created, a lot of it's flowed back into the stock markets and into bond purchases and those sorts of things. So it's not necessarily hitting the real economy directly.
Well, it's not only not hitting the economy, it's draining the economy of capital. The reason we don't have real economic growth is because capital is being diverted from Main Street to Wall Street. So if we want real economic growth, we need more savings so that we can have more legitimate capital investment. But we're not going to get more savings until we have higher interest rates. But the Federal Reserve is actually discouraging people from saving, as are central banks around the world. And they're encouraging reckless debt, which just fuels asset bubbles and consumption, all of which undermines real economic growth.
And interestingly here, the Reserve Bank governors several times said people have to move into the market, take market risk if they want any sort of returns.
I know, but first of all, you're distorting the markets by causing all this money to artificially bid up prices. But in the end, the losses are going to be horrific. To say that, well, people have no choice but to take risk, I think they do have a choice. I don't think they have to buy overpriced stocks. Now, fortunately, if you look around the world, there are stocks that are not overpriced. I mean, I find that there is still a lot of value in the markets if you spend the time to look for it. So you can buy companies at reasonable or actually cheap prices now and get good dividend yields. But also, I think gold and silver are still very cheap relative to the amount of fiat currency that's been created. And I think there's a lot of opportunities in the mining sector. I think a lot of these stocks are going to be raising dividends significantly over the years. I think their cash flows are going to improve dramatically as the price of gold rises much faster than the cost of producing it. And Australia will be a main beneficiary of the remonetization of gold because there's a lot of gold in the ground to be mined and other resources. I think you're going to see a boom in natural resources. All sorts of minerals that Australia has in abundance are going to be in demand. And so the economy is going to pick up. But I particularly think that the Chinese are going to be even better customers in the future than they were in the past. I mean, once they stop wasting their money on U.S. treasuries and U.S. mortgages, and the Chinese consumers actually start to spend more of what they produce as opposed to loaning it to Americans, you're going to see major demand for raw materials in China. And I think trade is going to increase dramatically between Australia and China, as trade is diminished with the United States. So I think both Australia and China will trade less with the United States, but they'll end up trading more with each other.
Let me just come back to gold for a second, because obviously a number of central banks around the world have been acquiring gold. And in fact, many other people, even in some Asian countries particularly. What do you think is there a sort of a drift away from the US dollar?
Well, absolutely. I mean, right now it's a drift, but it's going to gather momentum. I mean, the smart central banks are buying. But what I think we are headed for is a remonetization of gold. The U.S. took the world off the gold standard with Bretton Woods. But then we broke our commitment to the world in 1971 by defaulting on gold backing. The US dollar never would have been accepted as the world reserve currency, but for its convertibility into gold. That's what made the dollar as good as gold. So I think the next step, now that we have so massively abused the privilege that the world has given us, I think the next step is for the world to go off the dollar standard and back to the gold standard, which is the standard it was on prior to Bretton Woods. Because currencies need to be backed by something. So when currencies were backed by gold, they were backed by something real. When currencies that were backed by the dollar, that was backed by gold, they were still backed by something real. Through the dollar, the world was still on the gold standard. But now you have currencies backed by dollars that are backed by nothing. So if you back your currency with something that's backed by nothing, then you've got no backing to your currency. And this is the problem with the modern monetary system, is there's no real anchor. There's no real value to the money. And so it can just be created at will. And you have the potential for a loss of confidence, which is where we're headed. So I think the world remonetizes gold. And in order to do that, the price of gold is going to have to rise substantially from its current levels. Otherwise, the only way it's possible is if the price of everything else collapses. And I think that's less likely than the price of gold rising to where it would need to be given the current level of prices for other assets and consumer goods.
Right, and you, I think, have expressed a view that it could be $5,000.
Well, no, I think it'd be a lot higher than that.
Okay.
More like 10 to 20,000. And of course, it's a moving target because it depends on when the remonetization occurs. Because between now and then, a lot more fiat currency can be created. And so really what gold is doing, gold's not going up. It's just letting you know how much value all these fiat currencies are losing. And so the more they print, right, the more unit of each currency would then be required to buy an ounce of gold, because the global supply of gold doesn't really change very much. I mean, it grows slightly on a year-over-year basis, but money supply can just grow exponentially. So if they just keep printing more money, well, that doesn't mean there's any more gold. So now all that gold just has to, go to more and more money. And so the price of gold just has to go up for the market to clear.